Okay, so today we're going to talk about all things construction loans. When you want to build your own house, all kinds of questions pop up. How much cash do you need in order to do that? What's the approval process? How much loan can I get? What are the costs involved in that? We're going to answer those questions today. We're talking about a construction loan, and the construction loan is different in terms of the approval process than if you were to buy a ready-built house. And the reasons will become obvious, or they may be obvious for you already. But there's really three different approvals that are required in order to get your construction loan funded and started. There's the borrower approval, so that's going to be the most familiar to you, right? We're all pretty familiar with that process where you get your credit, your income, your assets, your occupancy, are you going to occupy it as a primary or not, and your liabilities. Now, one distinction here, when you're getting approved for a construction loan, you're building your own house. It's a custom construction. This is not about spec lending builders, building a house to sell. Wholly different. This is someone who wants to build their own house, hire a contractor, and you need financer for that. And the thing that is maybe different from a qualifying standpoint for the borrower is that you're in a house right now and you're looking to build a new house. And so if you're renting, no big deal. Every lender will ignore your current rental situation because they know you're renting and it's not something that you have an obligation to. You can break, even if it requires breaking your lease, you can get out of that. It's not a monthly obligation you're going to have, so they'll ignore that. But if you own a house and you're planning to live in it while you're building this new house, then a lot of times they will require you to carry both houses to qualify. Now, many lenders understand that this is not the long-term plan, not the long-term intention, and that burden won't be upon you for that length of time. But you do have to factor that in, and so just be aware of that. Some lenders will take the rental value and offset that against the payment. Other lenders will ignore it entirely, but just be aware of that could be an extra hurdle. So that's the first thing. You need to get, just like you would to purchase a home that's already built, you have to get yourself qualified to purchase this home or to take on that loan. But then you need a builder approval as well. And so you see here, there's several elements to that builder approval. Builder's credit, builder's project history. Most lenders aren't going to want to take that builder's first project of your scope. There's a lot of builders who work for other people and they swing a hammer and they go, I can do this. I'm going to go out on my own and start to build these houses. And they may be 100% right in that, but they have no history to prove that. And most lenders aren't going to want to finance a home that is being built by a contractor, a builder who doesn't have experience with that scope of a project. So typically you're going to see 2 to 3 years of history of the similar type scope of project. And then they're going to need subcontractor references, supplier references. Again, because especially in this market that we're in right now, there's all the supply chain issues that can create problems for your builder if he doesn't have those relationships established. And so they're going to want to check all those things. Then, of course, they're going to be licensed and bonded. They're going to need to have all of that thing. So just be aware, those are going to be required. I did have a deal that I was not able to finance with a construction loan because the builder, I'm 100% sure was extremely well qualified, and I think he's building the house now because he found a lender that was willing to do it. But my lender wouldn't, because he had no experience with the scope of project that he was taking on. And then the third thing is there's going to be a project approval. You've got your borrower approval, you've got your builder approval, but you also need a project approval. When you're buying a house, it's already sitting there on the lot. It's got similar comps that have been sold. You can look at it, touch it, feel it, and an appraiser can go out there and inspect it, and you can assign a value to that. But when you're building a construction loan, you've got an idea. And that idea has a lot of data behind it. You're going to have a contract with a builder. You're going to have a cost breakdown that's very, very detailed, a materials breakdown that tells you, exactly what quality of materials, what kind of cabinets you're going to have, what kind of countertops you're going to have. All of that will be included in this very detailed breakdown because that's really the only way. If someone told you, I'm going to build you a house and it's going to be 1,500 square foot, how much will you pay me for it? Well, you'd want to know a lot more about that, right, before you'd answer that question. Is it going to be a luxury home with lots of nice amenities? Is it going to be bare bones? And so all of that will be included in this contract with a very detailed cost breakdown and a very detailed materials breakdown. Also be aware that most lenders require this be a fixed cost contract. Most lenders won't do a cost plus because they're qualifying you for a certain amount, and they don't want an open-ended contract where if costs go up substantially, then you no longer will be able to qualify for that. And all of these things are because the last thing a lender wants is to have to step in and foreclose on a property that's not already done, and then to hire a contractor or offload it themselves. That's a very difficult situation for a lender, and so all of these things are the reasons why these sorts of requirements exist. So you'll need plans and permits. Now, all this is needed before you can fully approve a project. Now, you can approve a project pending permits, because sometimes permits come in later. They won't fund your construction loan until you get permits. So just be aware of that. You won't get your first dollar on your construction loan until you have permits. And then an appraiser will take that contract, they'll take that cost breakdown, they'll take that materials breakdown, and they will give it to the appraiser, and the appraiser will take all that and go to the site and say, okay, if you build this house according to these specs, then it would be worth X in today's market, and that's the appraised value that we're going to use. And then there's also prepaid items. That's a little bit more nuanced. We can talk about that later. But basically, just be aware that you may think, that go ahead and, getting started because a construction loan may take a long time to get approved. You got to get your borrower approved. You got to get your builder approved. You got to get your project approved. And maybe you've got some things that you need to get started. Maybe you've got, maybe you've got a foundation guy that's not going to be available in a month when your loan's going to be approved, and you want to get that started, but you've got to pay some money up front. Just be aware there are very specific requirements for getting reimbursed for those sorts of things. So don't just go out there throwing the money out there thinking, well, I'll just get that back when I get my construction loan. Make sure you're familiar with the lender's requirements for getting those items covered if you plan to get those covered. But let's also talk about financing the land, because of course if you don't have land, you can't build a house. You have to finance the land first. And it's technically possible to finance the land with a construction loan, but it's very, very difficult practically because we've just looked at all the requirements for getting a construction loan, and all of those requirements are required to be completed before that first dollar is dispersed on your construction loan. So if you're planning to finance the purchase of land with that construction loan, you have to have a very patient seller. Right, and the other thing that should also be considered is that you have to invest a lot of money into this deal before you become the owner of that land, and that can be very risky, right? Because you have to have plans, you have to have specs, you have to have a contract with a builder, you get your architectural plans, you have to have permits. All of that stuff has to be in place before that first dollar will be dispersed on that construction loan. And if you're planning to finance the purchase of loan with that, that means your seller has to be very patient, because construction loan isn't a 30-day close, as you can see from the process. It's going to take longer, sometimes significantly longer. But also you're going to have to invest a lot of money up front in order to get that land ready to go and get that project ready to go before that loan gets financed, and then before you become owner of that land. So just be aware of that. That could take several months, but then also be aware that typically before a lender will finance land, they're going to require utilities to the site. They have to have a plan for utilities. We're not typically talking about financing 20 acres in the remote mountains where all the utilities are going to be very difficult. Typically they're going to require some sort of plan for utilities. You have to have electricity at the boundary. Typically in Washington State, most of the time you're going to need a water source. That means you have to have a well actually drilled if you're planning on that. If you're planning on public water, if it's to the site, then that's fine. But if you're planning on drilling a well, if you're doing septic, for example, just having a septic design approved by the county is all you need, because there's not a lot of uncertainty beyond that. But when you're drilling a well for water, there is uncertainty there. You don't know if you're going to hit water, how deep you're going to have to go, how much it's going to cost. And so with all of those uncertainties, typically you're going to have water to the site and gas and those sorts of things. So just be aware you need utilities to the site. And then as we talked about before, the other elements, if you're going to finance this land with your construction loan, you're going to need architectural plans, a builder contract, permits, etc. So just be aware of that. If you already, if you're just financing land by itself, also be aware typically the down payment requirements are fairly significant. Most land lenders are going to be, upwards of 30% down or more, and then the terms will vary considerably as well. One of the differences between land lending and single-family lending is, single-family lending, we're all used to kind of the Fannie and Freddie box, and we're all trying to fit in that box. And the two, Fannie and Freddie, have very similar boxes. Maybe they go outside of one another in slight different areas, but it's very similar. Not a lot of variation across the board. We all kind of know what the requirements are. Land lending is not going to be like that. The land lending is going to be very niche-y. Every different community bank will have their own guidelines. Whether they're willing to lend, with 30% down or 20% down, what kind of requirements they have for the lot, what kind of inspections are required, what the term of the loan is. Many land lenders are only lending to get the construction loan. And so they will give you maybe a 3-year balloon instead of a 30-year loan or a 25-year loan or even a 15-year loan. Now some do, but just be aware of that. And so with construction lending, as with land lending, it's a good idea to call around. And that's, I didn't mention that about the construction loan itself, but it's the same sort of principle there. These are not cookie cutter loans. They're not cookie cutter programs. Many different lenders will have many different niches and programs and pros and cons. Some of them, for example, won't fix the interest rate in up front. You do a construction loan, typically you're going to have minimum of 6 months, more likely closer to a full year before that property is completed. Then that lender can then deliver that loan to the secondary market. So you have interest rate risk for that whole year before that loan can be delivered to the secondary market. So many lenders deal with that by not allowing you to fix the rate in. When you go into a construction loan, you have a variable rate loan, and then they'll fix it in at the end of the construction period. So you can go into a 30-year fixed rate, but you won't know what that rate is until you get to that period of time. Now, some of them will fix it in up front, but just be aware of that and just factor that in. Make sure you ask lots of questions when you're asking around about your construction loan, about your land loan. Now let's look at an example here. What I want to talk about here is how much cash will you need. Now in this example, I'm going to assume that this land loan is going to require 30%. Now if you've inherited land, or if you already own the land, you've been sitting on it, that's great, especially if it's owned free and clear. Because you've got this asset, it's already there, you don't have to acquire it, you've got the time then to work on the architectural plans, you don't have the uncertainty of whether you're going to get the loan or not. But let's assume in this case that you have to finance the land and then you're going to get your construction loan. So in this case, I'm assuming that the purchase price of land is $350,000. Now, I don't know where you're watching this video. That can seem extremely expensive in some markets and not so expensive in others. 350 is not so expensive. I'm in the Seattle Bellevue area, and a well-developed lot. Like in this example, I'm assuming this is a developed lot. So there's electricity to the boundary, there's a well source, there's a water source, either a well on the property already operating or a public water source. There's a sewer, public connection, or septic design already in place. So there's no setup cost involved in this, but you pay $350,000 for this lot. And again, in my market, that's not super expensive. But if you put 30% down, you're already $105,000 cash into the deal. And so you see that right here. You've got your $105,000 into the deal. We're going to say that in this case, you don't have to do any lot prep, but then you will have some soft costs. And these numbers I'm just grabbing out of thin air. So I really don't know what an architect's going to cost you, what plans and specs are going to cost you, what permits are going to cost you. But I'm guessing that my numbers are pretty low here as well. So I just threw in $5,000 for architect, plans and specs, another $5,000, $25,000 for permits. And so right now, and again, these are all costs before you get your financing, before you get your construction loan. So you're $140,000 into the deal cash out already. So now I'm going to show you the difference in construction loan financing between when you own the land for less than a year or you've owned the land for more than a year. And that makes a difference. When you're financing a construction loan, most people are familiar with the idea of a loan to value. How much will a lender lend you relative to the value of the home you want to purchase? So if you're a veteran and you're VA, you can put 0% down. That's 100% loan to value. If you're conforming, regular borrower, maybe you can go with 3% down, that's a 97% loan to value, or 20% down, that's an 80% loan to value. But in construction lending, the relevant metric is it's loan to cost, typically. Construction lenders will lend on the lower of the loan to cost or loan to value. And so you'll still get an appraisal, right? We talked about that. You'll have an appraisal done, and it will be done by an appraiser, and the appraiser will tell you, if you build this house, it'll be worth, let's say, $1 million. You build this house, it's a 2,000 square foot house, it'll be worth $1 million when you get done. But your cost, let's say your cost is only $800, including the land cost, including all the construction costs, including the soft cost, your permits and your architectural plans, etc. And so the lender's only going to lend you on the percentage of loan to cost, not percentage of loan to value. Now there's a slight variation there, and that's why I want to show you two columns. One is if you own the land more than a year, and one if you've owned the land for less than a year. So this first column here, in this example, I'm assuming we're going to build a 2,000 square foot home, and it's going to cost $250 per square foot, so it's going to be a $500,000 builder contract. And so when we're building our loan to cost here, we've got land cost or land value, cost us $350,000, we bought it less than a year ago, so it doesn't matter what it's worth. It's $350,000 is all we get for it. And then we get the soft cost we looked at above. I estimated $35,000. I think that's pretty light, but we'll go with that. $500,000 of builder cost. That's the 2,000 square feet at $250 a square foot. So that's $500,000. So your total cost in this example is $885,000. Now let's say this construction lender will lend 80% of that. So they're gonna lend you a maximum of $708,000. Now remember, in this example above, when we bought the land, we financed this land. We put 30% down, so we borrowed $245,000. Now we have financed the land with a separate land loan, but we have to pay it off. The first draw on a construction loan is always going to be to clear the lien or any liens that are against the land. A construction lender won't lend in second lien position or behind anybody else. And so the very first draw on this construction loan has to pay off that $245,000 land loan that we used to purchase this. And so that means we have $463,000 left available right now for this $500,000 builder contract. And so you end up in this situation, you're $37,000 short. You don't have enough, and you have to put that money in at closing. Now you may you may go to the lender and say, look, I've got $100,000 in this money market account. I've got more than enough to cover that. When I run out of these construction monies from my contractor, I'll put the rest in. And they're not going to allow that. They want to make sure that those funds are available to them, are available to the contract, and they can't leave them at your discretion during that time. So you have to fund that at closing, even though it's not necessarily needed right away. You have to put your money in first. And so that's another $37,000. And so in this situation, we are $177,000 cash out of pocket into this deal. And so that's with a 20% down scenario. That's when we put 30% down to begin with to buy the land, and then we had a $500,000 contract. So this is just this is the example where we own the land less than a year. Now, what if we've owned the land for greater than a year? There is some help here. Let's assume that we own the land for greater than a year, and now we bought it for $350,000, but now the land's worth $450,000. If you've owned the land for a year or more, most construction lenders will give you the value. And when you get your appraisal, the appraiser is going to value that land separately. And so, that will be a component of a regular appraisal. They'll say the land today is worth X. And if that land is worth $450,000 instead of the $350,000 you paid for it, then you get to use that $450,000 as value. As cost. So in this case, instead of having an $885,000 total cost, we have a $985,000 total cost, and we can borrow 80% of that. Now in this case, that's $788,000. We pay off our land. That leaves us $543,000. Now we only need $500,000 for the builder contract. Now the lender's not going to give you that $43,000 back in cash, that excess, but it will fully cover your builder contract. So in this situation, you don't have to put additional funds into the deal at closing. So all you're out at this point is the $140,000 that you put in to buy the land, and you got essentially everything else out. So anyway, that's a basic overview of some of the more important elements and differences in a construction loan. Obviously, there's a lot of details there, but take a look at that. Hopefully this helps you out. If you have any questions, feel free to reach out to me. My contact information is below. And also, if you like this, go ahead and subscribe and like and share. Thanks so much.